Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. Welcome back to the show, Bob.
Yeah, hi, Jim. I always enjoy our get-togethers on Friday.
Bob, the Canadian federal government deficit is projected to be $343 billion this year, a debt of over $1 trillion, and you notice the quote from our Prime Minister Justin Trudeau: "We took on debt so Canadians wouldn't have to." Well, great, because who's going to pay for that? The Mexicans?
That's right. And it's an astonishingly stupid statement, naive and the worst. And to think that he would think himself that he can get away with it is amazing. But then that always goes back to the 1930s, where it took on huge debt and said it doesn't matter because we owe it to ourselves. And then you get into a period of rising interest rates, and then the debt service charges become immense. And of late, interest rates have been remarkably low. Begin to rise a little at the longer maturities, particularly for lower grade debt, as T-bill rates come down to zero. So this rise in interest rates is likely to continue, in which case the cost of servicing the debt gets horror show, and it's not good for governments to take on a huge amount of debt, in this case supposedly on behalf of Canadian citizens. And it's the old theme. Another old saying is that governments don't have any money of their own. Government is just the agency. And when a country is in debt, the public is on the line one way or the other. And this one is not going to come out well. The problem is that, let's back up a bit on this, Jim, is that with the Federal Reserve in the States and the Bank of Canada in Canada going crazy, reckless in throwing liquidity into the market, this has got all the gold bugs going again, and they're back into the 1970s thinking where, the dollar's going to go to zero and gold is going to go to 10,000, and that's been hyped into the market. But the return of inflation as they understand it, which means soaring prices for the cost of living and wages and all that sort of stuff, is not going to happen. What happens following a great financial bubble is generally most items deflate. Stocks, bonds, commodities, everything. And this is what has been happening. So the problem and threat to the bond market is not the inflation of the 1970s that drove the long Treasury bond up to 15% in 1981. No, it is going to be the problem whereby there's so much debt and into a weakening economy, it can't be serviced. So then it becomes an issue of avoidance of risk. So, and this seems likely. You've had, with the financial bubble, you've had the real price of industrial commodities such as base metals and particularly crude oil went up. And then with that also, and going the other way, the real price of gold went down. And the real price of gold has gone down in every bubble in history. And then it goes up, and the real price has really been as in a strong uptrend, and that's very favorable for the gold sector. So gold stocks have been outperforming the general market. But to close out on the statement by Doe, it's by a stupid young man, and he's assuming that the rest of the world is as naive as he is. And it's a keeper, that headline.
Well, I know they always keep comparing Canada's debt to other G7 nations, but it's almost to the point of, well, the house next door had 10 murders and we only had 9, so we're doing great.
Oh, yeah. Well, of course, you have the province of Ontario got itself into the biggest debt load on a per capita basis of any sub-federal government, like a state or a province. I think virtually in the world, at least the Western world. It's a horrendous debt problem in Ontario, which is supposed to be the industrial sector of the country. And no, Canada's in quite a mess. And it will be realized on the next leg down in the financial markets. The credits, as you know, we've been looking at the financial markets rather clinically, and which goes back to this time last year in 2019, when earlier in the year you had Turkey and Argentina central banks running out of their reserves and a huge liquidity loss and currency crash and rising short rates. And then that hit India and China at about this time last year. And then that's where we said, okay, this is now a developing credit crisis and will likely hit the U.S. in the fall. And then on September 9th is when all of a sudden the money market in New York just lost liquidity, breathtaking fashion. And then that's when the Fed had to do the huge repo operation. And at the time we wrote that the amount of money that the Fed is pouring into the money market represents the degree of the crisis. So then there's another one, Jim, that is very important, and that was what's going on with the yield curve. And the yield curve is the difference between short rates and long rates. And in the end of a boom, the yield curve, where short rates go up faster than long rates, so it ends up being in what they call inverted. And we've got a chart on the yield curve back to 1857. And the conclusion is that every inversion of the curve has been followed by a recession. And then early in the year, the curve inverted again. So we looked at when you had kind of like a second attempt at inversion, and that happened last in 2007, which was followed by a hard recession. And then two other notable occurrences were in 1929, that bubble, and we all know what happened after that, and also in the previous bubble, which blew out in 1873 and was followed by a Great Depression. So then in December, January, our indicators were, we had overboughts and upside exhaustions and sequential sells, all of that stuff. Before the threat of the Wuhan flu virus got into the market. So our advice then was to lighten up on stocks and bonds, and it turned out to be right. So what this portion of our conversation is about, Jim, is that we looked at the markets as a cyclical change before the news of the Wuhan flu hit. Now, the Wuhan flu has caused the sharpest economic drop in history, at least back to 1665. And that's when London had the Black Death, and it killed something like 25% of the population. So you can imagine how fast the economy and market shut down then. So anyways, this is extraordinary, but it's it's more than a diversion, but it is also part of the credit contraction. So we're going to stay with that. Now, in March, we noted that that severe liquidity problems in the stock market could last about 2 months, and that 2 months counted out to the end of March. So March 19th we noted that bottom was soon, and the rebound could run into mid-year, and here we are at mid-year. Now, also at that bottom in March, we had the opposite of our technical signals. We had huge oversolds, capitulations, and sequential buys. And now, what have we been getting over the last number of weeks? Overboughts, upside exhaustions, and sequential sells. So it's time to take some money off the table and watch for some adversity in the fall.
We'll have more with Bob Hoye right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Welcome back. We're speaking with Bob Hoye. Bob, the stock markets and the emerging markets have really taken a pounding. What's happening there?
Yeah, they're calling it the everything bubble, and then it was the everything correction, and then it was the everything collapse. So, the headlines have been on the giant five stocks in the NASDAQ, Tesla and Apple and Netflix. Those things are incredible. And of course, I consider that the Tesla, which now is up to a market cap larger than Toyota, which is the largest real manufacturer of cars in the world, and over decades been a very well managed company. And Tesla has a market cap that's greater. So it is a phenomenon, and it ain't over until it's over. But underneath it, you now have, like the New York Stock Exchange comp. It set a very good high in January, sold off, and has only recovered part of the give up. And again, we're noting that we've had all of these technical excesses being accomplished on the upside. And our note in May was the old saying, sell in May and go away. And that one, of course, you're not going to make that statement if the stock market is not speculative in May. But when it's measurably speculative in May, you got to get the story out. And then and it's consistent, that if there are statistics that show the return on the stock market from November to May is consistently good, and the return from May to October is consistently either zero or bad. And so what we're looking for here now is we've had nice rallies in base metals. That's always constructive. We've had a nice rebound in crude oil, and that's constructive. But then what you want to look at is that base metals can have a cyclical low in October and November. Lumber has had a very nice rally, and it can often have a cyclical high in June and a cyclical low in October. And then the key one, of course, is crude oil. And what we're now warning our readers about is that you can have another cyclical wipeout for crude oil going into January, maybe extending into February. But you have to face these things, and when the markets are very strong, it's an opportunity to lighten up on your portfolio.
We'll have more from Bob Hoye right after the break.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Bob Hoye. Bob, U.S. pending home sales hit a record 44% in May. Is that a good sign for the U.S. economy?
Well, it's a good current sign that there was a terrific rebound in that economic series. But I think what you got to look at is that the financial markets, stocks and bonds back up a bit, stocks and lower grade bonds got trashed straight down. And then you're going to get a rebound, and it's been straight up. In the case of the NASDAQ, straight up and beyond. But many analysts have gone beyond that to say that the economy will have a V bottom. That was the buzzword on that one. And I don't think so. There's too much debt burden. But again, it goes back to the way the credit markets behave. With a great boom, with an outstanding boom, the yield curve will invert. And as we talked, it inverted. And then as part of the transition to the contraction, the yield curve goes the other way. And then the other part of the credit markets is credit spreads. And they narrow as the market bids up junk bonds relative to treasuries. And then when that changes, now these two items, credit spreads and the yield curve, when they get on a trend, it lasts for a few years. And then when they reverse, that also lasts for a few years. So, no, I think that the housing number is a good one, but it's pretty wild. And there's also things going on where many people are leaving the big city centers because of all the troubles, and are moving to perhaps safer, quieter areas. And then the numbers for the unemployment figures, I've always been skeptical of those, even in good times. But anyways, lately they've been all over the place, and again, it'll force short-term moves in the markets, but it's not something to watch. So we would not be looking at the economy and saying that it's going to spike up and then that will extend the recovery in the stock market. No. And then the other one that's on is that the street is also considering that because of the huge accommodation by the Fed, that is going to keep the stock market going up. But that's not the case either, because in 1929, the Fed stepped into the crisis and provided huge amounts of liquidity, and it didn't work. And actually, they kept buying bonds right through the whole first bear market there. And Barron's in 1932 pointed out that every anti-deflationary measure taken by the Fed is not working, and the anti-deflationary measure was buying bonds out of the market. So it's been tried before, but it hasn't worked. So we live in very interesting times.
Also, you saw a headline that described Jerome Powell as Dr. Feelgood. What's your take on that?
Yeah, that was a good line by Jim Grant, who heads up the interest rate advisor. And he is a genius in writing. And, yeah, it's not so much Powell, it's the head of the Fed has to say comforting things. It's not the individual saying that, it's the public man saying that, and he has to come out with comforting statements. And thus the term Dr. Feelgood. I think it was a nicely crafted line. And it's not the financial history, Jim, since the advent of the Bank of England, which was a central bank with the powers of issue, that was formed in 1694 in England, in London. And at the time, the promoters behind it said it would infallibly lower interest rates. So here we have it. Since the first big financial bubble brewed up in 1720, crashed and was followed by a lengthy contraction, and then 1929 was number 5 on the list, and it's quite possible that the market that peaked in this January, it may have ended this period of great bubbles. So what history says about the ability of central bankers to keep a boom going, it says they can't. And just in the example of the Federal Reserve System, which has been running for more than 100 years, the promoters behind the Fed originally claimed that as a lender of last resort, it would prevent the crises, the financial crises that preceded recessions. So that's the theory, and Jim, it is a very appealing theory, and it's been an appealing theory for 100 years. But there's been 19 recessions since the Fed opened its doors for business in 1914, and then the official, semi-official agency that determines the business cycle, the NBER, a month or so ago came out and said that the economy peaked in February and we're in a recession. So that makes number 19. So effectively, there are 19 proofs against the concept of successful central banking. And there's not enough self-criticism by interventionist economists and interventionist central bankers. But I think that with the probability of another period of liquidity problems coming up, perhaps after August, then there could be a critical review of the boasts of central bankers. I'm looking forward to it.
We'll be chatting with Bob Hoye again in a week. Thank you so much, Bob, for being on the show.
Oh, Jim, always good to be with you and with our listeners.
My guest has been market historian Bob Hoye, the chief investment strategist for chartsandmarkets.com. If you have any questions for Bob, you can send them to info@housestreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HoweStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HoweStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HoweStreet.com radio is a production of HoweStreet Media Incorporated.